Hello everyone, welcome back for another daily cryptocurrency market update. And this one, although we're going to relay everything that is taking place right now on the current sort of economic landscape to the cryptocurrency space, this one is going to be very kind of macro focused because yesterday we had non-farm payroll, which is essentially where we get stats on the labour market within the United States. And we saw a massive disappointment in regards to these stats. And we are also seeing an uptick in unemployment. Now, this is very much a double-edged sword. The two sides of this sword really summarise the camp that you're in when you're looking at the markets in the sort of short to medium term. And that is, the one camp is, okay, unemployment going up and a significant miss, which we'll cover, we'll take a look at what the miss was in unemployment, means that the Fed is essentially a lot more likely to lower interest rates, which means that the Dixie's going to lose ground, which theoretically should mean risk does well. The other side of that sword is, okay, well, unemployment's going up, the negative side, if you will. Does that mean that we are sort of hurtling towards a recession, which even if they did lower interest rates would essentially mean that the markets wouldn't do very well, because the correlation between unemployment and the S&P is when unemployment's at a low, the stock market is typically at a high, and when unemployment is at a high, the stock market's typically at a low. So it's very important, the data that we got yesterday, and you've got to ask yourself, certainly, you know, the name of the channel is Allincrypto, we are Allincrypto, but often when we're trying to figure out what's going on with the cryptocurrency market, we need to keep an eye on what's elsewhere. I see a real issue with people just having their blinkers on. And, you know, there's so many amazing projects in the cryptocurrency space that are, in my opinion, going to play a vital role in tomorrow's world. We're going to be using some of these layer ones without even knowing that we're using them, in much the same way we use technologies like the internet, the various things that are associated with the internet, or more kind of primal. You know, we get into our car in the morning without even thinking about the technology that an engine is. So despite that, the prices of these cryptocurrencies are very tethered to the macro situation. We see a big correlation with sort of Bitcoin, crypto, and the stock market and the risk category more broadly. And it's our assessment that crypto is going to be the best performing asset in an environment where risk generally does well. And that environment where risk does well is when they start to lower interest rates, we start to see the Dixie rolling, like we've got confirmation of today, which we're very much expecting. We're seeing a big move, not just for the Dixie to the downside, but the Great British Pound to the US dollar and the Euro to the US dollar to the upside, like we were expecting. Also, the Japanese yen gaining a bit of ground. For the first time in 30 years, actually, the Japanese or Bank of Japan actually upped interest rates from 0 to, they did a 25 basis point rate hike. We ultimately think that that sees risk do quite well, providing that there's no kind of March 2020 style event, or that things don't get bad like we enter a recession, we start to see GDP just completely plummet, which we haven't seen yet, and we start to see unemployment really start to skyrocket. We're seeing the sort of first signs of unemployment upticking. The question is, does it continue? And if you're in the bearish camp, your answer will be yes, and that we're entering a recession very quickly, and stocks will adjust to that. The other camp that you're in, which is mine, is that actually we're in a good economic situation, which we think is going to be created by all the stimulus and this kind of banana public that we're now entering, and that the Fed are going to lower interest rates, and things aren't going to be as bad as we think, but ultimately, or something, but ultimately risk does well in that environment. And certainly technically that's signaled to us, i.e. when we look at charts across multiple different assets, and we've derived an opinion from dividing the likes of Bitcoin with gold, or Bitcoin with the SPY, or Bitcoin with Amazon, or Bitcoin with Tesla, which is a recent shout from us in regards to Tesla doubling. Crypto is going to be the best sort of performer in this, and then, you know, dividing Bitcoin, of course, but then you can look at Bitcoin dominance, where that's going, and we are predicting some downside for that. But with the events that took place yesterday, which is why we're making this video, there's a lot of uncertainty being introduced into the market. We're going to cover it all. We're going to make sense of it all, and of course, we're going to relate it all to the cryptocurrency space. So let's dive into, of course, what took place today. And this video will be coming out tomorrow. I'm away currently right now, guys, or I'm sort of taking this Saturday off, but we're still going to be releasing content. And I really wanted to get a video out on the sort of significance of yesterday's events that we're covering today, which of course is Saturday, the 3rd, I believe it is. So yesterday we had non-farm payroll. Now, non-farm payroll has been consistently high. So this is when they look at jobs essentially added or taken away from the economy in the United States that are non-agricultural. So we've had consistently high jobs added to the economy Obviously, this makes sense. Of course, they're twiddling or fiddling with the stats, of course, statistics, and damn statistics. But we've had successive, really high prints, which makes sense given the kind of shutdown that we saw, and then the kind of reopening and the flurry that comes out there. Now we're seeing this kind of slowing at a time when interest rates are very high. And of course, the Fed's mandate is to secure price stability, but also ensure that there's a very strong labour market. And we're starting to see the weakening in that. And the probably more significant one was the unemployment rate, which came out at 4.3. The expectations were 4.1. The correlation with unemployment and the likes of the S&P, and you can see it very clearly here, unemployment is in black, S&P is in red. When unemployment's at a high, stock market is typically at a low. And when unemployment's at a low, you can see this, stock market is very typically at a high. Typically, it's not always the case, but generally it is. And that's because the sort of labour market is a good barometer for how the economy is doing generally, and typically you'll see jobs getting lost in a recessionary environment when things are hard for everybody. And you can see this kind of uptick that we've been having. Now, that's the one edge to the sword. That's the bad news. The good news to this is, of course, it's going to put pressure on the Fed in regards to lowering interest rates. So we know they kept rates where they were on Wednesday. I personally think... This is my take from listening to Jerome Powell on Wednesday, that the markets didn't like the uncertainty that he kind of introduced. Because I do think he was very uncertain in his approach. He said, okay, yeah, September's, it could happen, but we've not made a decision on that yet, and it's very data dependent. The Fed don't want to cut interest rates, certainly before the countries do, because they know the effect that's going to have on the Dixie. We're going to look at that. We'll look at the correlation between the Dixie. What all this means for crypto, we'll talk about in just a second. But they kind of did, but didn't hint at a September cut. And obviously with this unemployment, although one thing that he continues to cite would, if we see reason to react, we will. And this is absolutely that reason to react. The problem is, yes, okay, this lowers interest rates, which takes the wind out of the Dixie sails, which we knew was coming. But is this... this generally isn't good for markets. Is unemployment sort of upticking? And again, the question you've got to ask yourself is this? Are we heading towards a recession in the near term? In the next 3 months, in the next 6-7 months to a year? I think we've still got this grace period that we're in. That's my personal take. I think we're going to have a crypto bull market before the SHIT hits the fan, essentially. I think the yield curve isn't uninverted yet, and I'm talking about the 2s and 10s here, the most accurate one. But Friday we had that, and then obviously we've had this news, which of course is putting pressure on the Fed, and you can see that now the probabilities aren't just that they're going to lower interest rates by 25 basis points, but that they're going to do it by 50. And if anybody's familiar with typical Fed lowering cycles or easing cycles from a interest rate point of view, they don't do it in a slow... They're not a snail when they do it. They do it quite fast and quite rapid. That's historically how it's gone. Sometimes that's been a symptom because of the economic environment, whether that be March 2020, whether that be, 2008, whether that be the dot-com crash, and they've had to really bring them down fast. Those two, certainly 2008 and the dot-com crash, are two examples people give of pivots being bad, but they weren't initially. And just like with March 2020's events... when they really lowered interest rates, they'd pivoted long before that, and you had a period of about a year where the markets just went up. That's what I'm expecting, but we need to be mindful. I'm long the cryptocurrency market right now. I'm sure those of you that watch me daily will know this. We need to be very mindful that things aren't spiraling out of control. That is the equation that you have to solve here. You have to stack reasons for why you're long and you don't think that we're heading for an SHIT storm, or reasons why you're short. And a reason why you might be out of the market is because, okay, there's a lot of uncertainty based on unemployment right now, and that, unemployment's not something that sees the market, an uptick in it, and a kind of recession isn't a good period for the market. That's not the camp I'm in until I see reason to be so. Just like we weren't in the second round of inflation camp that many people have been in for the past year or so, as we've seen continuing decline in inflation, it started to go sideways for a period. We said it was going to continue to decline. The dollar was going to go with that. And of course, rates were going to come down as a result of that. We've seen that happen thus far. And I'm very much in the, okay, even though unemployment's a worry, I need to see a little bit more before we totally pivot. And the stock market will typically rally. I think is it 3 or 2 months prior to a recession. So it only really starts to price in very close to the time. And I think we've still got quite a bit of runway ahead of us. So we are going to get rate cut in September. Something happened for the first time, which I'll show you in just a second, in nearly 3 years, that also signals rate cuts. September was very much a given, but now we're looking at a 61% probability to do a 50 basis point cut. We saw, this is, and I'll explain all this, it's essentially Fed funds on its head, but it's a future predictor. So this is the 30-day Fed funds interest rate futures. So it's betting on where interest rates are going in, and this is a 30-day future. This is a 3-month funding rate futures. And you can see, since January 2022, this has continued to go down. We'll put the Fed funds on here. It's kind of like an inverse chart. So when this is going down, that means rates are going up. You can see this. And now we're having, for the first time in nearly 3 years, an uptick, which means that rates are coming down. Which I believe is going to take the wind out of the Dixie sails, and the correlation there is that sees risk assets do quite well. And I want to show you guys that. Because this is where it links over to the crypto space. Because crypto is obviously a part of the risk asset class, and ultimately, in my opinion, is going to be the best performer. And we'll show you that. Gold doing rather well on the back end of all this. Let's pull up the dollar. Let's get the Japanese candlesticks back on. Get rid of the RSI. I do apologize, guys. And show you what we're looking at. So if we go to a weekly time frame, it's our belief that the Dixie is coming down to the lower band of this sort of channel that you've been in since 2008, when we know what happened in 2008 and the subsequent actions that took place after. We don't want to explain that in much detail. I'm sure everyone's well aware. But the correlation between the Dixie typically, and we knew rate cuts were coming. I mean, if you look at the move that the IWM, which was another stock we were long on, had. I mean, Sandra Druckenmiller, the guy's a legend when it comes to the markets. It was all signaling that this was going to come. The question is are we going to see rate cuts as a result of, we need to get these down to zero as quick as possible because things are breaking, or are we going to be in that sweet spot, which I actually believe we're going to be in. I think that has a lot to do with their ability to react. So the correlation between risk, just putting risk on generally here, is Bitcoin, SPY, and gold. You can see obviously the events of March 2020, all the printing that took place, low rates. This obviously fueled the bull. Then you're seeing inflation spike, interest rates going up. This obviously fueled the bear and the topping of the markets. Then this topped out, the markets bottomed, and they've been generally going in an upward trajectory since this has been coming down. Then we entered this sort of sticky sideways period. It's our assessment that it's going to continue to come down. We can derive that based on interest rates and where we ultimately believe they're heading, because this obviously affects the dollar. Let's put the Fed funds on. Quite high level stuff here, guys, but it's important stuff that you need to pay attention to. And I really, one of the missions that we have here at Allincrypto is to help people understand markets. Yes, you're into crypto, but if you understand the sort of pie, the bigger picture, it's going to give you a lot more of a kind of edge in regards to predicting what's going to happen. So as interest rates, which we know are coming down, not only are we looking at the CME, not only did we get the news to sort of cement that and give them a reason to do that, we're also getting this from the 30-day futures, and also this one's showing it a lot more, the 3-month futures. This is well and truly a breakout for this, which means rates are coming down. Rates coming down typically means that the dollar, or certainly the Dixie, will come down. What's the fundamental reasoning behind this? Well, the Dixie is the US dollar versus mainly the euro, and then the likes of the Japanese yen, the Great British pound, a number of other currencies in there. Other central banks are lowering interest rates also, but they don't have such a large debt market, meaning that what they do with interest rates has a far more or less of a degree in regards to what the Fed do, because their dollar debt markets they are the market, they're the biggest market in the world. So when they were upping interest rates, we saw other countries doing the same thing. The thing is, though, the dollar upping interest rates has far more demand on the back end of that. And just like when they lower it, it takes a lot more wind out of their sails. So we have every reason to suspect the Dixies do well. And the correlation there is that risk does well on the environment of that. The thing is, we really need to avoid a shitstorm. And I think we're going to avoid it. I truly do. I think when we look technically at things, that's what's very much signal. The yield curve isn't uninverted yet. And I think we've got this grace period. We're not going to escape that SHIT storm, but we're going to do kind of, I believe, a March 2020 style. And I'll show you this on the... no, I won't. I'll show you this on the 30-day. So if we get rid of this and we put on the S&P, for example, you can see we're in a very similar spot to the last time they started to up interest rates. Now, of course, we know this led to March 2020. Are we going to have another March 2020 in regards to that specific event? I'm not 100% sure. But if you look at when they started upping interest rates and we saw a similar move to what we've seen today, or lowering interest rates and we saw a similar move today, the market went on an insane rally on the back end of that. This is why we decide to, or we continue to sort of dismiss the fallacy that every time the Fed up at lower interest rates, that means a crash is coming. Every time the Fed pivot, a crash is coming. We were one of the few people to say we're actually bullish on sideways rates because of the correlation that has with the markets. Like, here, for example. But when they started to lower interest rates, you can see there was this kind of chop here for the S&P, and then it went on this major run, which we're expecting this kind of blow off top into an SHIT storm. And we ultimately think crypto is going to be the best performer in that. So we're seeing the dollar roll, very much following the plan that we set out for it. We're also seeing the Great British Pound start to march towards targets that we have for it. This is the 10-year yield, which has broken down. The dollar's very correlated to this. Certainly the Dixie. And it's the 2-year that I really want, which leads Fed funds. So this is yield curve. We can pivot onto this in a second. So rates are coming down, ladies and gentlemen. The question is are rates coming down because, there's... things have now broken, or are they going to come down in a sort of orderly fashion and we're going to kind of escape an abyss? And I'm in that camp. But this is significant what took place. It introduces a lot of uncertainty to the markets. I'm not particularly, I must admit, bearish on, this is Tesla, which I'm actually really bullish on Tesla, by the way. Certainly if we have this kind of sweet spot environment that I do think we'll have. I'm not really bullish on the S&P. I think the S&P has done spectacularly, and I think it well deserves a pullback at this point. And you're still getting a good distance between these highs. It's not kind of marginally topping out, kind of like what you saw over here. So I think this is just a pullback that ultimately will sort itself out. But the markets really aren't liking what's been introduced. Crypto not doing too badly, so we still believe that certainly for Bitcoin, we have this $151,000 target. For Total 2, we have a $3.8 trillion target. For others, we have a $1.9 trillion target. It all adds up. Everything that we're looking at points in the same direction. And we're now getting confirmation in regards to the direction we thought the Dixie was going to go. It's just on slightly badder news than what we thought. So this is the real equation. If you're a bear, you're betting on unemployment skyrocketing and a recession being in the near term. Months away. This year, going into sort of the start of next year. I think it comes later than that, and I think the markets do well up until that point. That's it, sort of short and sweetly. And in that environment, like for example, we're seeing gold do very well today. Now, gold's been following the sort of technical roadmap that we've set out for it spectacularly, guys. It truly has. This was an inverse head and shoulders. We're nearly at our target for this. Now, calling a 25% move in gold, people are like, 25%, this is crypto, it can do that in a day. But no, it's significant in the gold markets, and then we're calling it for go to 3,500. Bitcoin is in an uptrend against gold, and we have higher targets for Bitcoin against gold. But actually, so is the Total 2, the altcoin market. And you can see this had crypto's been sort of pulling back. Very normal in regards to where it's in for the cycle, but we have higher targets for it, and it's going to outperform gold. Certainly if it gets that 151k, gold only gets to the targets we have for it. It's also in an uptrend against the SPY, and there's cross correlation here, and we've got significantly higher targets for this. So this video really was just to sort of explain what's kind of going on in the macro, because it's important. And you're really in two camps. You're in a recession is in the near term, and the markets are now going to plummet, or we have a period of time before we enter a recession, and the markets will do well during that time period. Markets rally into a recession. Equity investors typically are glass half filled kind of people, and they'll buy into it essentially, and then we'll get the SHIT storm that we very much do expect is coming. We just don't think it's yet. And to maybe finish on a little bit of a side note about the yield curve, this is important stuff to keep an eye on, guys. when we're looking at our predictions for sort of how the markets are going, it's being followed beautifully. I mean, it really, really has. Of course, you would get a kind of spike up in the yield curve here. Put it on a monthly time frame. This 2s and 10s has been a great indicator for recessions, for crashes. And I think it's going to continue to be that. I'm not going to bet against it. But typically the crash happens once it's uninverted, and furthermore, after a period of time of uninversion, and that period of time can differ. I think we've got that kind of year's grace period, much the same that we saw when they started to lower interest rates going into March 2020. And that leads me to believe that potentially, and you can base this on the 4-year cycle theory, the global liquidity cycles, the end of this bull market, and I hesitate to say this because it's not really a great predictor, is likely going to be coming, this is just theory, towards the back end of 2025. That's my assessment on everything. You know, when I look at housing, we spoke about UK housing recently. We did a video that did very well. When we look at, you know, US REITs, when we look at even bonds, we're bullish on. When we look at gold, when we look at the S&P, okay, we don't have a target, but we're having targets on things like Tesla, and we're getting a lot of breakout for the smaller stocks that we got targets on. You know, and then when we cross-analyze that with the crypto space, crypto's going to outperform, and actually we've got individual targets for crypto, which kind of backs up our theory on outperformance and certainly Bitcoin dominance and everything. We've got this really rounded picture, which drives us to be in the sort of camp of, okay, we're not entering a major recession and a major downturn. What we're getting right now is an uptick in unemployment after a very strong unemployment stats and kind of cooling off of that, but this isn't us entering a recession. And you've also got to think, a very interesting thought to love and leave you on is what happens in a world where AI has very much replaced, and AI agents have very much replaced a lot of the workforce. That world is coming, and how does that affect the markets economically, and does that throw off prior sort of correlations? There's a lot to think about. It's one of the interesting times I've ever been in the markets in my short career, and even, you know, older boys that I know that have been in the markets for as long as I've been alive times 2 or 3, you know, more like 2. You know, they're sort of also saying a similar thing. It's a very interesting time to be in the markets. But that's it from us. We wanted to report on yesterday's events and how the markets have kind of, at least initially, digested this. We still think this crypto bull market is well and truly on. It's because we're in that other camp, not that we're entering recession in the short term. Yeah, we'll enter a nightmare, but it's not coming till later on. And timing is everything in the markets, because ultimately you can't just sit out of them until something happens. You know, that then you become like a Dan Pena or a Robert Kiyosaki, in my opinion. So that's it from me, ladies and gentlemen. On that note, I'm going to love and leave you. If you've enjoyed the content, like is appreciated, so as a comment, and I'll see you all in the next one. Thanks for watching, guys. See you in the next.